My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey guys, welcome back. You've probably heard of house flippers because I've interviewed a gazillion of them on this show, and you've probably heard of venture capitalists. And you may or may not know exactly what that means, in which case you're in the same boat that I am. But I have never interviewed a gentleman that's gone from flipping houses into being a venture capitalist. Well, that's what we're doing here today. I've got David Gritz zooming in from beautiful New Jersey, and David is a real estate entrepreneur. He spent a lot of time doing flips. He still maintains some buy and hold rental properties, but these days he's big in the venture capitalism space, venture capital space, especially when it comes to prop tech type stuff, which we're going to unwrap in today's interview. So David, welcome to the show. Great to have you.
Yeah, great to be here. Thanks for having me on your show.
So, David, give me a definition, if you will. Let's pretend I'm just a dum-dum, and I don't even know exactly what venture capitalists are. So, why don't you just kind of unwrap that and explain to us what that means? Your definition.
So, simply put, venture capitalists are a class of investors that invest in private companies that essentially have extremely high growth potential. So we're talking about like 100% year over year type of growth. And most venture capitalists tend to focus on some type of technology or technology enabled service. And, there's a whole different set of classes. There's, like early stage, growth stage, and kind of late stage. But, in that whole universe, we focus on early stage. Our niche in the universe is primarily insuretech, or technologies that connect to the insurance industry, which, anything in the property side is tremendous, because if you think about it, anyone with a mortgage probably has insurance on their house or their rental property. And, ultimately insurers care about what you're doing to protect your rental property or your houses from storms, floods, or anything else that could go wrong with them.
Okay, so let me see if I got that. So zooming out, big picture is venture capitalists are kind of like the sharks on Shark Tank, but instead of trying to find the next best ShamWow, you are looking specifically at typically software type companies. You guys like to focus on early stage, so the founders just getting things up and running. Ideally, it's working, but it hasn't really gone to market in a big way. You guys get in there early, you pump a bunch of cash into those companies. I'm assuming in exchange for ownership, partial ownership of those companies, and you're looking to help them grow that company and therefore create higher returns for yourself and your investors. Am I getting it?
Yeah, we're usually minority shareholders, so we own anywhere between 1 and maybe 15% of a given company. And the goal is, through our wisdom and connections, we can help the already, really solid founding teams to get their companies to the next level.
Okay, very cool. So give me an idea, 1 to 15% ownership. What does that, I know it's all over the board. What does that typically involve as far as investment from your side? Like how much?
So just like an example type of standard, we have a company. I was just at their board meeting in San Diego in March, and basically they focus on taking some of the heavy paperwork that insurers use and processing it in a more efficient way. So imagine you're a multifamily owner and you have 10,000 rental properties. You probably have had more than your fair share of claims or losses against those properties from storms, slip and falls, or whatever may have happened. Every year you have to get all that paperwork and documentation to your broker to requote, and it's painful. So this company helps to automate and simplify that. But we have, a $500,000 investment in them. And, we invested when they had a valuation, slightly lower than 10 million. So, that gives us, a piece of the company.
Okay, so I've never been involved in anything like this, David, so forgive me if I'm asking very basic questions. Is this a situation where you guys are investing 500,000 and other venture capitalists are also investing in that company and they're looking to raise multiple millions of dollars from a whole bunch of people?
Yeah,
Are you
yeah.
part of
So
that group?
their round was a $1.5 million round.
Okay.
And there was one other investor that invested 1 million that we brought together into the round with us.
Okay, cool. So two of you involved and between the two of you 1.5 million. And that, what did that represent as far as ownership for you guys as
Yeah, so
investors?
between both of us, it represented about 16% ownership in the company.
Okay, great. So that injected 1.5 million into the company, helps them keep the lights on for X amount of time, pay the bills, pay staff, keep things rolling until they either become profitable or need another round of funding. Is that correct?
Yes.
Yeah. Okay. And the other question I was going to ask you is besides the money, what else do you guys, are you involved in any other way with the company? Or are you just hoping that they'll take the money and do a really good job with it?
So I would say, most venture capitalists, and maybe this is a little controversial, they say, hey, we do a lot. We help the startups and, we help them with growth and hiring and finding customers and all of these wonderful, magical things. In reality, probably like 20% of venture capitalists actually help the startups and 80% just sit there and watch
And
and, are,
wait for the
are
checks to come in.
cheerleaders. Yeah, cheerleaders in the background.
Yeah.
So that's just being realistic. But in our case, we genuinely try and help. So with the company I referenced, we have a board observer seat, which means we sit on the board, but we don't vote. And we're very active. We got them introduced through our accelerator program to a client that could end up being, a seven-figure relationship. And I just got a text from them, actually about an hour ago about another client that they might be onboarding that we know very well. And they have one division that they know, and we know another division, so we can act as like a back channel with them to help them forward that relationship. But we've done everything from reviewed contracts that they had, with their customers, to help them get through the complex navigation process of large enterprise contracts. We've helped them to secure their fractional chief revenue officer, so like the team side of things. And then, we've also helped them with product strategy, pricing, figuring out how to tailor their product so it can be most useful for their clients. Because, we know many of their potential clients and talk with them all the time.
So on the business side of things, as a venture capitalist, are you doing this kind of like we assume that the sharks are, that you've got very deep pockets that you're putting your own money into these deals, or do you raise capital from other people to fund the deals that you get involved in? How does that side of the business work, David?
Yeah. So venture capital is very much like real estate syndicates. So typically the fund manager puts in some amount, anywhere from, 1 to 5% of the fund. And then the remainder of the capital is sourced externally from, outside investors. In the case of venture capital, it's pretty much all equity investment. So, individuals are participating on the equity upside. There's very rare situations where debt investors will invest in venture capital. There's actually separate funds that are called venture debt funds, but that's kind of a more esoteric product that's out there.
Okay. So you're raising capital from a bunch of investors into a fund, and then you go find these opportunities that make sense to you, and then you put the capital from the fund or part of the capital from the fund into that particular venture. How how long, I know every business is different, but what do you typically tell your investors as far as time frames? Like you put your money in here, don't be expecting any kind of dividends or cash flow type payments from this. It really is about creating a big pop after X amount of time. What's the
Yeah,
time frame that
so
you're
these
typically
are
looking
very
at?
much long-term investments. I mean, contractually in our limited partner agreement, it's 10 years with the right to extend 2 additional years.
Mhm.
But based off of the data for the companies that we invest in, most of them exit in the 5 to 8 year time horizon. So I would say, I think our investors will have their kind of capital returned in that 5 to 7 years, and then the big upside, the 3 to 5x will come anywhere between the 7 to kind of 10 year time horizon.
So what does an exit actually look like in this scenario?
Yeah, so just give you an example, we have one portfolio company that just got an offer. They were in our fund one, and believe it or not, we only held them for about 2 years. So we invested in them. I think the initial valuation was around 9 or 10 million euro, and they received an offer in the 30 to 40 million euro range. So 3x increase in value in 24 months. But I would say typically venture investors look for 10x returns. So if you're investing in a company at a $5 million valuation, you're looking for them to exit at 50. And the reason why is because venture capital is very much I'll call it either a power law industry or a sin-based industry where you make up for your sins by having a bunch of really good ones,
Yeah.
or your bad decisions. So venture capitalists assume almost 50% of their portfolio will go to zero or just return 1x, and then they'll have one or two that are 40 to 150x, and then the other ones are kind of in the middle, anywhere from like 2 to 40x.
Yeah, that makes a lot of sense. And yeah, so it's definitely a long-term speculative type of thing. However, it sounds like you're getting investors to invest in this fund. The fund is investing in multiple different projects. You're spreading the risk across multiple different companies because some of them are going to tank, some of them are going to do okay, some of them are going to be home runs. You're never quite sure exactly which one's gonna really take
Exactly.
off. Yeah.
Yeah, so we invest in about 7 companies a year. So our expectation is over the 4 year investment period, we'll own shares in between 25 and 30 companies. And then of those, the top eight will reinvest additional capital. So people like to say, double down on your winners. So you'll have more concentration in the ones that really fly.
Okay. Well, thank you. I appreciate you giving me a big broad stroke overview of how this works. It's making a lot more sense to me now. So, David, when these companies that you're investing in, they're looking to cash out, what does that actually mean? Are they getting bought out by a larger competitor, another company? Are they going public? What does that actually mean? Like what is the exit plan of these companies usually?
Yeah, so I would say there's usually about, three potential types of exits. So the most common exit is, a cash purchase from, either a larger competitor or a large company in the industry. So, there was a recent announcement. I think it was Redfin that sold recently to a mortgage company. So that would be an example. Like, there were venture capitalists that invested in Redfin early on, and then they got purchased. Another example is a company that did tenant screening called Cozy. They got bought by apartments.com. So that's the most common path, is just a bigger company in the industry buys them.
Mhm.
The other possibility is they could go public. So, Zillow is an example of a company that went public, and, I own some shares of the public company. So the venture capitalists, I think, forget what it's trading at, somewhere between 50 and 70 now, but the venture capitalists that got in probably got in at like 50 cents. So, they did very well for themselves in terms of Zillow going public. But in general, like, going public is not that common. I think it's like, maybe 1 to 2% of venture-backed companies go
Wow.
public. And some years are bigger years than other years. Like 2021, a ton of companies went public. Last year, not very many companies went public. So we don't really like to base our model off of the companies going public. I would say in our portfolio, maybe one or two are possible to go public. But we don't need them to go public for a good exit. Like there was a company kind of in our space called Evolution IQ, and they just sold for, I think it was like 700 and million and change. So, the people that invested in that, and we know some of them that invested in the early rounds around like, 10, $15 million valuation, they did great.
Yeah.
So I would say those are the two main ways. And then the third way is that they could merge with another company for a stock transaction. And that company doesn't necessarily have to be bigger. It could be around the same size. And then, together those companies, may ultimately, exit again or have an IPO. In very rare circumstances, there's things where it's like a private equity buyout where private equity will recapitalize the company. The investors will get the capital back out, and then the private equity will either do a long-term hold or eventually flip it again. So that does happen sometimes. It's not super common. And then, of course, there's the other situation that you don't really want, which is, the company can go out of business or go into bankruptcy or something like that.
So you're really counting on, or the primary exit plan is somebody else buying them out. That's really
Yeah.
what
So
you're
basically,
based
when
on.
we invest in a company, we don't invest in them unless we've identified at least a handful of buyers.
Hmm. Right. So you're looking at them, you're saying, yeah, once these guys get their what together and they're appealing, they've got a unique kind of whatever that they're doing, they got a different angle on the line of business that they're looking at. If we can help them get to where they're attractive for a big player to come and buy them out, that's really the goal.
Yeah, the general rule of thumb is once they reach about 5 to 10 million in revenue and they have some level of profitability, they become, a interesting target for acquirers.
Nice, 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 nice. Interesting stuff, David. Big departure from flipping houses. So it sounds like you flipped houses for a while and then you've gotten into this in the last few years. Do you have a background in tech, or what got you really interested in
Yeah,
switching
so
from
I
flipping to this?
was I was in tech before I started flipping houses. Actually, my story of how I got into flipping is a little silly, but I worked at a pretty decent sized tech company, almost 7,000 employees, and I was fortunate enough to be hired by the CEO and founder. And the first year I had my review, this guy himself was a very large owner of real estate. He owned almost all the buildings that the company operated in. He owned, buildings that were leased out to universities. And in fact, his attorney was really his real estate deal guy, but happened to do like other legal work for
Yeah.
him. And, in his first review, he's like, David, you should really consider investing in real estate. You'll probably make more money in real estate than, working for me. And, I already had the real estate bug. I remember when I was a teenager, I read the Rich Dad, Poor Dad book. And then there's another entrepreneur that went to the same university as me named Paul Zane Pilzer. He wrote a bunch of books, like one called Unlimited Wealth. And his kind of first $1 million he made was buying rental properties in Long Island. He was an investment banker, and he wasn't cool enough to get into the houses where people rented the parties with all the Wall Street people. So he just figured, I'll just buy a house and rent it out to the nerdy people, and then I can be the landlord. And that's how he made his first $1 million. So I was kind of inspired first by Rich Dad Poor Dad, then Paul Pilzer, and then by my boss, my first boss. And I was like, I think it's destiny that I have to get into real estate. So I started with a rental, and then I had met a couple guys that were doing flips, and then I said, hey, I'm gonna still keep doing my corporate tech job, but I will find you guys the money and help manage things on the accounting side. So that's what I kind of contributed to the partnership.
Nice.
And in terms of the transition for venture, there was kind of a little turn in that way. As after I left corporate, I ran a startup incubator where we actually had startup companies living in, properties together that were close to universities. So that was kind of like the hybrid between real estate and tech and startups. And
Yeah,
then,
nice.
over time, I was just like, well, why don't I just go full into it? We started our own accelerator separate from the real estate component with a different business partner and focused in the insurance vertical, which I had, taken a little time and done a startup there. And then it naturally became, I guess, self-evident that investing in the startups that we got to meet made a lot of sense.
Yeah, that makes a lot of sense. David, if people want to connect with you and find out more, if you only had one place to send them, where would it be?
Yeah, I think LinkedIn is the best. If you just search my name, David Gritz, and my company, insuretech NY, I'm sure you'll find me on LinkedIn, and would love to connect and get to know you. And whether you're looking for feedback on real estate or you're trying to break into venture capital, happy to be helpful.
Awesome, David. Well, thanks for being on the show. It's been a lot of fun.
Thank you.
All right, everybody, take care, and we will see you on the next episode. Hey there, I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now, at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.